I can't begin to tell you how excited I am to have you here as part of the first ever Chart Summit. This is a virtual technical analysis conference. What do you think? I can't believe we pulled it off.
I think it's great. Thank you for inviting me. I've been very impressed all day. I've been inspired, especially by Mike here, and listening to a whole variety of people who, I see that I incorporate a whole lot of various things. So I hope that how I put things together will be helpful to people. Um,
I think the perspective that you bring in, your experience, I think all of us here are thrilled to have you. And I know I have my notepad and pen ready to take notes. So I'll just shut up and let you do your thing.
Okay, thanks, JC, and thanks for including me. And I just hope I can keep up with the quality that I've listened to all day. First, a little bit about fusing fundamental and technical analysis. I think that if you know my background, which is economics with kind of a concentration in math, and then a real interest in arts and the visuals, you kind of see how I put a whole lot of things together. It wasn't really until I came to Wall Street, which is true of most people, that I discovered technical analysis. But so taking a whole lot of my interest, putting it together, and I think my interest in art, which is very visual, and some training in that has really helped in terms of interpreting chart patterns. And I think that chart patterns are really all about supply and demand, which is what is all about economics. And you put together some of that with some of the quant models that I use, which is leaning on some of my math skills. These are the things that I weave into my analysis. And I heard earlier today that, everyone should find their niche and what works for them. And I think that's so true. We all can approach this in a very different, unique way, but it's what works for us. And so I think you'll see that in my presentation. What I have for you today is a kind of a snippet works for us. And so I think you'll see that in my presentation. What I have for you today is a part of the S&P going back to 1871. Now, the S&P didn't really exist then, so I lean on Shiller for some of his data. And I've put it on a log chart so that you can actually see the price movements better. And we've all heard about these flat trends. And what I consider these flat trends, which I have these rectangular boxes, show you that the market spends more time in a flat trend, or if you live through a flat trend, you really are thinking about it's a bear market, a bull market, a bear market, a bull market, but it is a different kind of timing market. When it breaks out, then you go into a trending market. That's the time when everybody's smart because you can really buy and hold. And we've talked about this, technicians talk about this from time to time, but I went back to study what drives these flat trends. And there is an economic background to all of these trends, these flat trends. And if you understand that, then you can understand when it breaks out, or you can anticipate when it breaks out and know what that means. So if you go back to really the end of the 19th century, it shows that 10 U.S. states actually defaulted. We had a tremendous amount of debt. It was nationwide, and debt is deflationary because when debt goes bad and there are defaults, there is no money to buy anything. It's a very bad time. It's deflationary. That often leads to another cycle or, inflation. And the next flat cycle, as you can see, which was in the early part of the 20th century, inflation peaked at almost 24%. That was in June of 1920. And when that inflation cycle was under control, then we had the Roaring Twenties. We know the Roaring Twenties, we know about the crash of 29, and we know the debt that followed that, the bear market, and then the long debt that needed to get get fixed, and then into that wonderful period in the 50s and 60s, which was a beautiful bull market. And then inflation. The inflation in the 70s was really kind of a OPEC inspired. OPEC cartel was a big driver of the inflation of the 70s, but it was exacerbated too by the fact that the baby boomers are coming into the economy, and they were actually stimulating the economy. So you had many things going on that drove that inflation cycle that was finally killed by Volcker. And then we had that last wonderful bull market that we know led into the bubble. The bubble in 2000 was interesting. We had rolling debt. It started off with margin debt, kind of killed the bull market. When the market went down, then it went into real estate, and then the real estate bubble collapsed. The real estate bubble was household debt. It became financial sector debt, and then the bailout of the banks meant that it became government debt. And it was not inconsequential or unusual or surprising to me that we broke out to a new high in 2014 when the government did sequestration, which meant that we had not only fixed the household debt and the banking sector debt, but we now had a little handle on government debt. So we fixed our debt problem, and we have a cycle. So that was really, I believe that we are now in a secular trend. So we're in that kind of market where I think buy and hold can work much better than it would have before. I also look at the same thing from a mathematical perspective. This chart, 10-year compound annual growth rate of the S&P, is literally the chart that you just saw in mathematical form. So we've just looked at a 10-year compound annual growth rate for the S&P, the blue line, and for the total return index, that's the dotted line. And when you look at this, I think it's really interesting because we were talking earlier today, someone was talking about when was the beginning of this bull market and what was from the 2009 low or whatever. And you can debate a whole lot of things, but this chart shows you that there is usually a great buying opportunity once a generation, and that is when the 10-year compound annual growth rate goes negative. It did that in the early 20th century. It did that, of course, after the crash of 29 into the early 30s. It did that as well in the 70s, 74, and then we got almost matched the 1929 low in 2009. That was such an easy kind of buy opportunity. So what does that mean? That means that this cycle is unlikely to end. It won't be a straight line, but it's unlikely to end until the S&P, price index only, hits a minimum of at least 3150 in the next few years. There's no time on that. It's not a target. I don't give this, it's not part of my price target. In fact, my price target for this year for the S&P is 2340. I think it might be a little low, but that's my target. But this is to give a little backdrop about what kind of cycle we're in and how long it could last and how high it could go. So on a total return basis, these cycles haven't ended until you got more like a 17% 10-year compound annual growth rate. So I think we're in a very good, long bull cycle. I then asked myself, does this make any sense? And, while earnings are not, and fundamentals are not a very good timing advice, if you look at markets, they are always supported by earnings. And so earnings is a big part of my forecasting, and that starts with a GDP target. And this chart of GDP, quarterly GDP, shows that we just got fourth quarter, so that would mean that in the last 31 quarters, we were only had average or above average GDP growth for only 6 of those. This has been a very underperforming economy for the last 8 years. Now, you might say that this is terrible. It certainly hasn't been good, but it also shows that we have not been, GDP growth, we've been below our ability in the U.S. So the fact that we've actually been underperforming is one of the reasons I've been looking for reasons that we might get back into outperforming. So here's where a negative could really be a positive. So I take it one more step and look at GDP. This is the same GDP, except I've done it a little differently here. What we're showing are the components of GDP. And you can see that, if you look at 2009 going forward, coming out of the recession, the parts that have been the drag on GDP growth in the U.S. have been those black bars, which is exports, or the white bars with a thick white black border, and that's government investment. So the two things that have been very negative or have been a drag on our economy has been exports and a lack of government investment. And then the gray bars are private domestic investment. That includes investment CapEx, investment in structures and residential real estate. That's been a very erratic, very important part of the economy, but erratic. What's been driving the economy has been the consumer. So you can see that the blue has been what's driving whatever growth we've had has been totally consumer driven. Not a surprise, we kind of know that, but it's good to know that what we're seeing is, that we know where the problems rest. So it's pretty interesting, to see what's going on politically now, and the fact that the good thing about this last election, and I don't have any politics, although I do use politics in my strategy, is that both candidates are talking about investment in infrastructure. And so that part of the campaign was a very positive thing in my view. So let's look at GDP another way. Again, you can see I use a lot of visuals to display economic data. And here I've listed all of the cycle peaks, and I've indexed them, so they're all at 100%. And then you can see both the recession and the recovery in the economy. And this is one way of showing that this economic recovery that we've been in, it's labeled here December 2007, it's the thick blue line, has been below average. We showed it to you in GDP numbers, and now we're showing it to you in a different format, but we've had a real kind of sluggish economic recovery, the worst really since post-World War II. Well, investment in structures, I talked about the gray parts, right? The gray bars that were investment, and here's investment in structures, the structures component of GDP. Again, the worst we've seen, although this chart looks a little bit like modern art to me, no cycles, this doesn't seem to be a real pattern, but regardless, this has been a pretty weak cycle. If we look at the residential part, because housing is a very important part of our economy, it's a big driver, it has a lot of trickle-down effect. You get good housing, then you have good furniture, you have a whole lot of things that work. You can see that this was an interesting cycle, that the worst part of it came well after the beginning of the recession, and we're now in a phase where housing started to kick in, and it's interesting because housing started to kick in. And just to be clear, residential investment means investment in new housing. So it's the housing building component of residential investment. That it is been finally kicking into the economy in a very good way. So that's good because CapEx was slowing down. And then we get to the consumer. Clearly very important, and again the thick blue line is employment, a different way of employment. I'm not, even though I do a lot of economics, I don't really care that much about the monthly employment number, nor do I care about the unemployment rate, which we could talk about ad nauseum because it really reflects nothing. But here what we're looking at is what at the level, so December of 2007 was the last economic peak. From those economic peaks, what happened to the number of people employed, the percentage employed, and how did we recover? And if you look at this carefully, you'll see that in every previous cycle, there were more people employed 4 years after one economic peak through the recession to the next economic peak. It took 4 years, but we saw many more people employed. In our case, it took 7.5 years to get to the level of employment that we saw in December of 2007. So, very interesting to me, because in the political campaign there was a focus by Trump on jobs, and you can see in this chart that that was a very savvy approach, because jobs have been a problem. Again, it's not the number of jobs created in the last 12 months, it's really has there been good solid growth in jobs, and there really has not. But then, since we're talking about consumption, it's do those jobs turn into income? And here is a chart of real, that means after inflation, personal income growth. Again, indexing all those economic peaks, you can see we had the biggest drop in real personal income ever. And we just in October of last year got to the level December of 2007, and now we're about 1% higher in overall personal income growth in the U.S. than they were in December of 2007. When I go to my clients and we would talk about the economy, I would say this is the big donut hole in the economy. We've got a lot of things going for us, but income overall has really not grown, and consumption has grown, but really through credit. And so this is the weakness. So there certainly has been a lot of pain out there in many households. So just to say, there's a lot of potential out there for this economy, but it really does require a focus on not only jobs, but on good paying jobs. And that means with those two things, we're going to have a much stronger, robust economy. What the stock market really cares about, though, is not that backdrop, but it cares about profits. And so here, the top chart is looking at GDP corporate profits, and the black bars are profits after tax, and those are the ones that relate most closely to S&P, which is one of the things that I forecast is S&P earnings. And the bottom chart is the numbers on top, but it's the year-over-year growth rate. And I put this in here just to show that as of the third quarter, we got not really positive, but we started to get even, so that year over year there was a little rebound after 5 consecutive quarters of negative earnings growth. So the stock market has done amazingly well in view of this really weak fundamental backdrop. And so one of the things that I've been showing clients, and we've been talking about this for over a year, is that there are cycles to everything. And so I love cycles, and I love history, and I love working with numbers. And what this chart shows is that the blue line is the average earnings cycle for the S&P. And there's a cycle to it. The dotted line is the current cycle. So looking from that 2007 peak, the recession, the recovery. And what we pointed out was that it's very normal. So 2015 was a very bad year for S&P earnings. Everyone talked about the earnings recession. And did it mean that we would have an economic recession? I didn't think it would, because even though employment wasn't great, it wasn't bad, and that's the real key to an economic recession. But the earnings recession, strangely enough, was right in sync with the normal cycle. So the timing here was usually between 80 to 108 months from the last peak, you do get a recession. This suggested that we would have an earnings rebound starting in November of 2016, which is pretty ironic. But it goes to show that history and cycles can be predictive. I wasn't predicting that it would happen exactly, but I started to add some other things to this to show that it was also likely. Just before I move on to that, I want to show that the S&P historically has done pretty decent during the earnings recession, but that the price performance of the S&P tends to kick in when the earnings kick in, and that's where we are. We're at that point where the S&P should kick in. But back to earnings, could those earnings actually be rebounding in November? And one of the things that kept us of the view that earnings would rebound late this year was tied to oil. Now, there's been some talk about, a lot of talk actually about crude oil today, and sometimes it talks about, is crude oil pricing bad for the economy? And I would just stop to say a couple of things. That historically, people thought that higher crude oil prices meant higher energy prices, and that would be bad for consumers. And that kind of goes back to the 70s, where it really cut into pocketbooks. I think what was missing in the thought process currently is how important energy was to the U.S. economy, that we become more of an exporter, that we certainly are a big producer of energy, and in 2014 on par with Saudi Arabia. And I think a lot of people missed that, how important energy is to the economy, and it was a plus. From an earnings perspective, this triangles is the contribution that the energy sector has been to S&P earnings overall. It had been averaging 12 to 14%. When crude oil prices went from 100 to 25, it became a huge drag on earnings. And that's really what helped drive earnings down in 2015. But as we move into the end of this year, we're looking for that negative to turn into a positive. So again, we looked at history. We saw a cycle that looked like earnings should rebound the end of this year. That should help drive stocks higher. And we could put together the fact that that was pretty likely to happen. And it was likely to happen maybe in a bigger way than some people expect. And so, again, I will add my comments to the many crude oil comments that I've heard today. And there's a very, what I call, messy head and shoulders bottom that's going on, with a pretty clear horizontal neckline around 50-51. And the volume patterns are pretty much in line with the head and shoulders. The volume on the breakout was above average, not dramatic, but this, from a classic pattern interpretation, means that there should be a target around 62 and perhaps 75 in energy over time. Over time. Hopefully it'll go slower rather than faster, but when we get now to the first quarter, we're going to see on a year-over-year basis, the pricing for oil is going to be very good. That's going to be very positive to S&P earnings, for energy sector earnings, but for the S&P overall. And of course, that's what the market's been waiting for. It's been waiting for earnings to grow so prices could go higher, because for most of 2015, stocks went sideways, but PE multiples went up. And that was one of the things that kept people cautious. And so here I'm just going to throw out, this is my valuation model. It's really a PE predicting model. The blue line is the S&P. The dotted lines is what the model is predicting as the forecast based on my assumptions for inflation in short and long-term interest rates and earnings. I have $130 for earnings this year, with a little, for 2017, with a little luck, it could be low. You can see that the blue line is hugging the top of the fair value range. And so one of the things that most fundamentalists know is that low inflation usually translates into higher PEs. And so we should be trading the upper half of this trading range, but we're trading right at the top of the fair value range. So when people talk about the market being fully valued, it is not overvalued. You can see the bubble that started in 1997 and peaked in 2000. That was an overvalued market. We are not overvalued, but the market is dependent upon earnings for a sustainable advance, and I think that's a fair statement, and it's not anything novel for me. And then I start to add my technicals to that. So when I look at the fundamentals, I see a lot of potential in the economy, a lot of potential in S&P earnings, and then I look at the technicals. And one observation here, I mean, I think the charts look good. I'm a real old-fashioned trendline person, so I believe that you have to have higher highs and higher lows to draw an uptrend line, and it's pretty easy to find where resistance levels are. I picked the S&P and the Russell for this page only because I wanted to show that with the horizontal line that the small cap stocks of Russell 2000 were underperforming quite a bit in the end of last year, and then they've really kind of spiked up recently and now kind of trading sideways. But as I know JC in his presentation showed, all the indicators are making new highs, and this is really great confirmation. I love it when markets are going up, but that is one of the things that makes me nervous. So I always think that when everything's looking great, I should be more of a skeptic. One of the things I'm looking at here are the spread between the index and its 200-day moving average. I think there's a lot of information in this spread. The 200-day is a long-term uptrend, and the spread between the two, when the S&P sees the spread get above 10%, I start looking for something that might go wrong. I'm looking carefully at other technical indicators, but we're not there. You know, we're at like 6-7%, so really all systems go. The Russell is up closer to 15%, a little bit more iffy, but also a more volatile index. And so what this says to me and what I'm doing now is I'm watching small cap stocks, because if there's going to be a problem in this rally and we're going to be approaching the first 10% correction, we're probably going to see it first in the small cap area. But right now, everything looks fine. And then I look at macro technical indicators for the market. And the new high list, which is the top right, it looks fine. The AD line went to a new high on Friday. The top left chart is that of a 25-day up-down volume oscillator. It's my favorite technical indicator. It is an overbought, oversold oscillator. And in this indicator, it's the opposite of what you think. If you're in a bull market, overbought is great. Because when you're looking at the 25-day net of volume in advancing stocks versus declining stocks, what is a bull market if not buying pressure? So you want to see an overbought reading, a long one, a consistent one, maybe an extreme one, because that means that there's a lot of conviction and a lot of buying going on in that bull market. And like anything, when the volume and the overbought starts to slow down, that's when I get worried. The opposite is true in a bear market. Usually the bear market low will have a big spike in oversold, and then when we retest the lows, you want to see a much smaller, if any, oversold reading. That's a buying opportunity. So I love this indicator. And right now, with the indices having gone to new highs last week, we are not overbought yet. I give this indicator a couple weeks, but if we don't get overbought in the next couple of weeks, then that would be another sign of something to worry about. So you can see that the things like, I think everything is in confirmation, but these are the things that I'm worried about right now and that I'm watching. And then what I do is I have two different models for sectors. I look at relative valuation of the sectors, and again, it's relative valuation. So when earnings growth is slow, it's where's the best earnings. So I look at that. I have a Copic curve price momentum model that I use, and all of those things come together for my sector weights. But these charts are my relative performance charts. And so we all know what relative performance is. When the line's going up, it means it's outperforming the S&P. When it's going down, it's underperforming. And I put this in my weekly every week. And it's also one way that I also kind of challenge myself. I have my models, but what is the relative performance? Because my clients are all institutional. They want to be in the right sectors because they need to outperform the index. They need to outperform their benchmark. So if you look at the top, I'm overweight technology. It's probably been my longest overweight sector. Since 2013, it's been there consistently. We had a little blip at the end of last year. A lot of that was political, and we're back in track. If you go down the column, first column, energy, I'm overweight energy, and that's been actually opportunistic. We went overweight energy when we saw the oil chart bounce off of 25 and start to move out. And it's done pretty well. Not so far this year, but it did. Energy was one of the best performing sectors last year. A more recent shift for us has been industrials. And you can see that nice outperformance, and it's tied again to politics. So there's a little bit of politics in here, but since I don't do a lot of individual chart work, I was really enthralled by what I saw in the charts in Caterpillar and Deere. And also this infrastructure, government spending is going to be very good for them. Going back to the top, financials, a lot of talk about financials. It was a recent shift for me from back from underweight to neutral. But I think here it's a little bit overdone, and I'm kind of on a neutral pattern. And then the most recent shift for me is healthcare. Healthcare, huge underperformer, but it's actually, if you look at that relative performance chart, it's been such a bad performer, it's like a very oversold chart. So it may be more, it's more tactical, but it was an underweight for me, and I've moved it now to neutral. I'm not going to go through all of these, but I just wanted to give you a little idea about how I put all of my patterns together in putting my outlook for who are primarily, stock picker clients, how I give them the big picture. I'm going to stop there, JC, and give you some time for Q&A.
Well, I was going to tell you, don't worry. You're the grand finale. I mean, just firecrackers are just going off all over the place right now, and don't let us stop you. If you got something that you want to share with us, by all means.
Well, I have, there's so many different topics. I'm not sure. This is where I planned on stopping. I know I have some addendum charts, so we can just kind of go through currencies. Here's my page on currencies, and
What does that mean? Addendum charts. What does that mean?
Addendum means it's not part of the book. It's really addendum, you see. So it's not part of the presentation, but it's there. I always have an addendum to all my presentation booklets in case I get questions. And
I get all kinds of.
Yeah.
So what do you think about this dollar? Talking about this dollar index.
And that's why I put this in here. The dollar's bottom right, and you can see, and it's it was a really pretty dramatic breakout above 100, but I put the dollar right beneath the euro so that you could see how much this is the mirror. They're the mirror image of each other. And I think while the breakout from a price perspective is pretty impressive, I think the dollar is just going to make another trading range. So I think it's going to be more in a trading range for a good part of the year, which will be good, actually, for S&P earnings and for our economy. And one of the reasons is the euro didn't really break down like the dollar broke out.
It held, which I thought was an interesting divergence, no?
I think it's a very interesting divergence, and that's the thing. That divergence said to me, this may not be the kind of breakout that you think it is. I think that dollar long term, I love the economy. I think it's going to do well, but I don't think that we're going to see some of these targets in the dollar that some people are saying. I think it's going to be more of a trading range, and that ends up being a big plus for equities.
That's interesting. To me, of all of these markets, I mean, that right now to me is the big head scratcher. That 100 level in the dollar index. I've been, obviously I invited, some of the smartest people I know in here today. And a lot of that, selfishly, I want to know what they're thinking. And this is, this is one of the big head scratchers for me. Is certainly the U.S. dollar. A couple of things, Gail. First of all, I mean, I loved your presentation. I thought it was fantastic. You bring such a unique perspective and dynamic, to markets, and just a fantastic compliment to the other presenters, which I know you told me you caught a few of them. A few points that you made that I want to bring up. Number one, when you talk about crude oil, you have a shorter term $60 target, and then you really emphasized that $75 level over the long term, which I think gets back to, one of the main topics that we focused on throughout the day and yesterday as well, is really defining your time horizon, right? Before you do your analysis, before you enter that trade, what are your objectives? What are your time horizons? So that multi-time frame targeting that you're doing, I have such an appreciation for, if you're looking a little bit more short term, that $75 level is irrelevant, really. While if you're a little bit longer term, that $60 level is less relevant. So just a point that you made that I thought was fantastic. And then the other thing, you mentioned the overbought readings, how overbought is a good thing, not a bad thing, which is another point that a few of the presenters certainly made, and one that certainly hits home to me. How can an overwhelming amount of buyers possibly be a negative?
Right, exactly. Especially when you're talking about a volume indicator. So I would differentiate. I think that if you're looking just purely at prices, to me, prices, I use the 200-day moving average, as you know, but it's kind of like a rubber band stretching from home. You can get above or below the 200-day moving average, but you're likely to come back to that. So if you're too overbought in price, it's bad. But how can you be too overbought in volume?
Yeah.
I mean, buying volume that is what a bull market is. It's about buying pressure. So in a volume oscillator, overbought is a very good thing.
I love it.
I don't think I pointed out, but we've had 3 consecutive strong overbought readings each time the S&P was going to new highs. The only one that's yet to be confirmed was last week's high.
Which give it time, right? I mean, who's to say that this move is over, right? Wait for it to after the fact, in other words.
Right. I mean, I give those indicators just like I give the AD line. I give it at least a couple of weeks to catch up. And then, I would be looking for an overbought reading of at least 5 days in length.
So leave us with some words of wisdom, Gail. I mean, last night was a great start. I'm not sure if you caught it. I invited over some friends of technical analysis. Tyler Wood gave a nice presentation on the MTA and kind of the growth and the direction that CMTs around the world are kind of heading in. How many CFAs are studying for CMT and things of that nature, globally where that's headed. I brought in Josh Brown, longtime friend of technical analysis, Howard Lins and Phil Proman. And then today, as you mentioned, just killer lineup of, some of my favorite technicians for sure. It's nice to have smart friends, right? And so, we're talking about, thousands of people around the world interested in technical analysis, and, you're someone who, I obviously look up to, as one of my predecessors, and, I take your words of wisdom to heart, as does the rest of the audience. What can you leave us with? What sort of, experience, throughout your career that you can share to essentially, the next generation of technicians? What advice do you have for us?
Oh, lots of things come to mind, but the first thing that comes to mind is I think that technicians in general sometimes feel like they're treated like second-class citizens, and they make excuses, and I would say get over it. I don't think that's true at all. I mean, I talk to my clients are some of the brightest minds, in money management, and they're all closet technicians. They love it. So, I mean, and technical analysis is a fantastic discipline. What I would say is that there's all kinds of technical analysis, but I think that the reason my clients follow me is that they see the discipline that I have, and I think the discipline that I have comes from technical analysis, because as we know, you break a trend, it's black and white. In fundamentals, there aren't those black and white things that happen. And analysts tend to follow earnings, not predict earnings. So I would say there is no reason to feel that technical analysis is second rate to any other form of analysis. The other thing that is one of the things that I think about all the time, and as a market analyst overall, is our markets are changing. They're changed. I've lived through so many different changes, and we now know that stock, there's all kinds of different kind of stock performance, but ETFs are taking over and ETFs are changing. Just like the mutual fund industry really changed the money flows for the market, ETFs are changing the way stocks perform and sectors perform. And so one of the things that I didn't talk about today was that ETFs, sometimes you'll be trading a stock and your stock will do something really bizarre, and if it's in an ETF, that's probably why it did that, not because of the company. And that's what I'm finding a lot of my clients are finding. They buy a stock for its fundamentals, and then all of a sudden, it's down 10%, but it's really because something else in the industry happened and it took that stock down because it's in an ETF. Those kinds of things are buying opportunities.
Because of the inefficiencies. Well, let me ask you this on that note. So you're essentially insinuating that it's the ETFs in some cases that are driving the stocks and not the stocks driving the ETF. Before ETFs, and I wasn't in the business before ETFs, but before ETFs, when you look at individual sectors, right, and the components of those sectors and the relative strength in, say, industrials, would you see that sort of strength in the industrial space and then see things like Caterpillar getting a boost, or is that something that you're just seeing now for the first time through ETFs?
Oh, I think that the stocks in the long run drive the ETFs, if that answers your question. I just think that the day-to-day volatility in the stocks is driven by the ETFs, and it's noise. We've heard some talk about noise. There's a lot more noise in the markets today because of ETFs and because of the volume that's traded in ETFs. And so we as technicians have to incorporate that into our thought process, that some of what we're seeing in prices and price trends could be noise. And I try to be aware of, for example, if I like a stock, what ETFs it's in, so that I understand the noise when it happens.
But you're suggesting that this is more on an intraday basis than longer-term trends?
It's more on a day-to-day basis, not necessarily. It could be intraday, but it's very short-term, yeah.
Got it. So you're saying, so bigger picture, if Caterpillar is garbage, not to pick on Caterpillar, but if Caterpillar is garbage, the industrial ETF is not going to continue to drag it higher. It might see some selling and buying over a day or two, but at the end of the day, at the end, it'll kind of revert to the norm.
To the norm. It will have its own pattern in the longer term.
Got it. So it's just more on the short term is what you're suggesting, that we need to kind of just be aware that the ETFs are knocking these things around.
Right, and I you could, another way of saying it is that there are pockets of illiquidity from time to time, and we've seen that. Like the flash crash, and whenever there are those kinds of things, and I think it's important to, for example, end of last year, there were lots of hedge funds that were kind of shutting down, and what does that mean? That's selling pressure. It's selling pressure and liquidity issues. So I'm much more aware of liquidity hiccups now, and I have to factor that in.
And these flash crashes, these illiquidity events, if you will, they're happening more frequent, right?
Yes, and bringing it back to ETFs and futures, it's because there's more trading done in these things. So it's kind of one big vicious circle. So we do have more volatility. However, it's noise. And
so you're seeing institutional buyers with too much exposure in a particular vehicle, in other words, where they shouldn't have that much exposure in that vehicle considering their size?
No, 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 not that. I'm just saying that there are a lot of there's a lot of trading. Let's just pick on the hedge funds for a minute. A lot of hedge funds who don't buy stocks, they only buy ETFs, and then they kind of go en masse into the market or out of the market. And I mean, basically, you could take a look at what happened after the election. The volume that was happening in the spiders, right? And so I'm just more aware of what's going on in the ETFs and trying to distinguish that between, you know, real buying. You know, it's another reason, by the way, I forgot to mention this. Forgot to mention that my up-down volume oscillator is NYSE volume only. So I take out all that day trading, and so it's just New York Stock Exchange. It takes away a lot of the noise in the volume that is going on.
I see. Well, Gail, I just want to tell you, I mean, the feedback that we've gotten from the audience has been tremendous. I want you to know personally, I really appreciate you being here. I think today and yesterday was an amazing couple of days. And if it wasn't for, the technology that we have today, whether it be via social or whether it be, platforms like this, although we did have a few hiccups, with the technology towards the end of the day, I think everything miraculously went pretty smoothly. What do you think?
I think it was wonderful. I apologize for bumping into, I couldn't find my mute button when I signed on. I apologize for that, but it really, JC, was a very well put together virtual conference. Thank you for inviting me. It was a pleasure. You're very dear, and I hope I kept up with the quality of what I saw earlier in the day.
Are you kidding me? You were the exclamation point on the day.
Congratulations.
No, thank you, and I will see you in New York in early April.
Okay, great. I'm looking forward to it.
I look forward to it as well. Thank you so much, Gail, and thank you everybody for attending today. You guys know where to find me if you have any questions at all. The videos will be archived and they will be sent as soon as my operations guys can handle that. Hopefully sooner than later. But you guys will get an email over the next couple of days. So thank you, Gail. Thank you so much.